Today's Cardinal lesson is keyword sunset. So in 2026 or at the end of 2025, the current tax rates, the current are lower than they used to be tax rates, are going to sunset. And the sun's going to rise in 2026 with the old tax rates. So right baked into the law, the tax law, the federal tax law, is a tax increase starting in 2026. So that was put in the original law back in 2018. It was actually passed in 2017 that we're going to have 8 years of these lower tax rates, and then beginning in 2026, they're going to revert back to what they were in the past. So what that speaks is an opportunity to do some things before 2026 happens. I want to bring Tom on to really talk about that.
Yeah, and so why we are doing this video, and we're starting to do this on all our videos, is give you the why up front, is we want to give you some real numbers as to why we do or why we recommend some of the planning strategies we do, like Roth conversions and those type of things, is taking advantage of these low tax brackets that we currently have and give you some numbers behind why it makes sense to do that.
Okay, so let's explain why we have, this is a pretty busy board today, and it has, a lot of information. So what's right here is 2023, as in right now, the tax rates. The lowest federal tax rate is 10%. The highest is 37%. And, you can see that it takes a married couple to get up to $364,000 in 2023 before they leave the 24% bracket and get into the 30s or get to 32. It takes a single person, when they exceed 182,000 of taxable income, they fill up the 24% bracket and get into the 32% bracket. So why do we need to know this? Well, we have a lot of people that are contemplating Roth conversions. And I would tell you that Roth conversions are probably going to make sense for some people, even at the higher tax rates in 2026 and after. But if they make sense then, they really make sense now. And so I just want to walk you through what it's actually going to look like in 2026. So I want to bring Tom on, and we really want to explain the numbers on the board and how we use these in financial planning.
Yeah, and so I think if we look at the board, you can, like I said, it is pretty busy. One of the things that we had to do when creating this is there's a lot of variables in tax rates. We had to fix something constant, and so we've kept the brackets, the income brackets, the same for the 2026 to do some calculations. So in actuality, it's actually probably going to be worse than what we've shown on the board, but we had to simplify the video some. And so what we have going on is if we look at that column on the board, the 2026 column, those breaks 15%, 25%, 28%. That's what those the old rates are, what it's going back to in 2026. And so you can sort of see, if you're in the 12% now, and it's oversimplification, but you're going to be in the 15% bracket in 2026, and you can just follow along there. And what we have done off to the far right side of the board under that married and single column there is shown you the additional tax you'd have to pay in that bracket by filling up that full bracket. So if you go to the very top of the 22 or the 12% bracket, that is then going to be the 15% bracket. That's an additional, if you're a married couple, an additional $2,023 in taxes by doing nothing, keeping your income the same. You pay that much more in taxes by waiting until that year. And then, you can sort of add those up. Those are cumulative. So, if you're in the 22%, that bracket, you're paying $3,000 more plus the $2,000 more from the previous bracket, and just so far and so on and so forth. And so that's sort of to explain a little bit. The board is there. It is a lot of numbers, but I don't know if Hans, you want to add any context more.
Well, what I want to explain is that a lot of people that are looking at Roth conversions, they go for this number right here, 364,200. So if we have a couple that are like at 150,000, 170,000, 130,000, somewhere between 100 and 200,000, what we're going to do is we're going to take their income as it is now, subtract it from 364,000. So let's say their income was 164,000. They can do 200,000 of Roth conversions And by doing that, they'll bring their income up from 160,000 to 360,000. And they're going to do 200,000 in a year, and they're not going to pay any more than 24% federal tax on that bracket. Now, they could get into some state income taxes, so we're going to factor all that in depending on the state you're in or if there's a tax. But the point being is this a lot of times ends up being the target number, is our customers have said, okay, I can live with 24% taxes to pay my taxes now to turn some of my pre-tax money into post-tax money or tax-free, okay? And for a single, we end up a lot of times at this number right here, 182,000. And so it's the same thing for a single person. So if they have an income at $100,000 a year, that means that we can convert $80,000 a year, and we can do it at the 24% bracket. And I think what Tom was alluding to is these numbers over here. I had never done this before preparing for this video. I said, how much are we talking about in real dollars if we're saying maybe you're going to start doing Roth conversions a little in advance of when you otherwise had planned to do it? A lot of people think they're going to start doing these after they retire, and maybe they're postponing them till then, and they've got a few years till retirement. For whatever the reason, there's really a benefit of doing some in 2023, some in 2024, and some in 2025. And to do that, if you add up all three of these numbers, they add up to $12,000. So if you've gone, and we have some people that have gone right to the dollar amount here. So they've done, for instance, $200,000 of Roth conversions, like my example, is when they're paying the tax on that, that tax is $12,000 less than it would be if they had waited till 2026 to do that. So we're just trying to get some comparative numbers to show you really what these lowered tax rates mean year by year for a few more years. And for a single, it's 6,000. So you add up all those numbers. So that's the general point. We don't want to get too deep into the numbers today, but we're showing you what we use to do a Roth conversion strategy. And with most of our clients, that's a multi-year strategy. I mean, we have people on like 5, 6, 7, 8-year strategies to, smooth out the taxes. And so they have a plan at the end of 6 years to have maybe 70% of their IRA converted over to Roth. So that's the income taxes. And Tom, you got any more to say about that?
Yeah, I mean, I think one point I would make is don't use this video to do all of your planning around Roth conversions. There are other factors you need to consider. So use someone who specializes in this. Call us. I mean, one specifically comes to mind is this is going to cause you to pay additional premium for Medicare. We don't use that as a stop sign, but we need to factor that in. And so, some people, if you do it on your own, they look at this, say, great, I'll do all the 24% bracket. 2 years later, they get this bill from Medicare that they weren't expecting, and they can be a little upset. So just, proceed cautiously if you're doing it on your own.
Well, yeah, it's also going to cause them to pay more taxes on their Social Security, potentially, not at these levels because they're already at the max, but it's going to cause that. And many of our clients delay their Social Security starting if they're going to do Roth conversions. But then if they're going to do that, then they're probably going to need to pull money out of their IRA to live off of, which is going to consequently reduce the Roth conversion. So as Tom said, there's a lot involved in that. We're just showing you one factor, but it's a pretty big factor, is that taxes are on sale for 3 more years, and that could tip you in the wanting to make the decision. Okay, the next thing that's changing is the standard deduction. As many of you have just learned about this as you've done your taxes, is you don't really write off your home mortgage interest, you don't write off your property taxes, you don't write off your charitable deductions because you just take $27,000 standard deduction because all that deductible stuff needs to exceed that. Or if you're a single, it's $13,850. And if you're a senior, I mean, it's it's over $30,000 and over $15,000 for a single. So that's taken a lot of people out of the itemized deduction game, and it's really given them a whole bunch of credit for deductions they may or may not have. Those are going to basically cut in half by the time we get to 2026 and it reverts. It's right in the law that this thing goes back to what it was. It's going to have an inflation index on it, and then I think they're going to add back in the personal exemption. So this isn't an exact, stating the tax code in 2026, but it's showing us roughly the numbers that we use to plug in into our formulas to make decisions about whether we're going to take advantage of something. Then the third area where there's an estate tax, and this doesn't apply to a lot of people. I mean, the estate deduction exemption, the estate exemption is right now almost $13 million per person. So if you have a couple that has 26 million in assets, if they were to structure things properly, they could literally use exemptions to get rid of the entire estate tax. And so when you start using 26 million as your threshold, that eliminates a lot of people in America, probably a lot of people watching this video. So I don't want you to turn me off now. I just want to tell you what's happening. Is the exemption is per person, it's going to cut in half. So it's going to go down to about 6.5 million, and that'll be adjusted for inflation. And that's per person. So again, now we have a couple where we talk about $13 million. And again, if people are going to get away with paying no estate tax and they've got right at 13 million, they're going to have to do a whole lot of things right to make all that play out. So I don't want to dismiss people, say, oh, okay. No, there's a whole bunch of planning you need to do. And the reality is if there's one person that is anywhere in the neighborhood of 4, 5, 6 million, or even a couple now, and they might not pass away for 30 more years, even 2 million, 3 million, we at least need to take a look at this, because this amount in the Tax Cuts and Jobs Act was doubled. So all it's doing is it's just going back to what it was before. And it very well could be that this amount is lowered even further, and we're not talking about that on this video. This is what it is, and it's very possible for people that are in their 60s now, for one of them at least to live into their 90s. And we really need to have a conversation about this and really plan more around this number than we do this number.
So some of the points that I'll make on the estate tax exemption is, we have a lot of people that I'm nowhere near that. But then when we start looking at stuff, they might have, farmland that's been in their family forever. That's many, many acres. That gets added to part of the estate. If you have a closely held business, a family business that's valued at a certain mean, you might not have a lot of cash or a lot of money on hand, but you do have an asset that can start adding up to some significant part of their estate. These are all people that need to be mindful of what's going to happen in 2026. I mean, the worst situation is, and we could tell you all sorts of different stories, but we've had, farmers come in, they have a big farmland that's been in the family forever. It's, above maybe not above the $26 million now, but could very well be above the $12 million in 2026. And when they look at their financial assets, they don't have the money to pay that estate tax, and the family has to sell the land to raise the money to pay the tax. I mean, that's kind of the worst case scenario that could potentially happen. And so we need to be mindful of it, and we need to do some planning around it.
Well, same's true with the family business.
Sure.
So, and that's the reason that they raised them to these high levels politically, is they were lobbying in there, and they're saying there's a lot of family farms, a lot of small businesses that are in the family. They want to keep them in the family and paying the estate tax. I mean, these levels were like 600,000 when I got my financial degrees and 8 estate planning degrees. So it's now 10 times that per person. So we used to have to plan this stuff for everybody. It's now a consideration. So I want to go through, and I want to just keep repeating that these 7 worries, these are the 7 worries right here, these check boxes that we do our financial planning around, our retirement planning. And so we've got them on the outside of the board, and we want to make reference to them because we want to show you how whatever we're talking about today applies. And it really doesn't have much to do with Social Security, but I'm going to go ahead and check the box because you do pay taxes on Social Security based upon your other income. And it has a lot to do with IRA 401k and what we talked about today, because we spent a lot of the day talking about Roth conversions. It has a lot to do with income, because one of the reasons we want to do Roth conversions is we want to source a tax-free income later in life. It has to do with estate planning, and it obviously has a lot to do with taxes. So with that being said, I want to bring Tom back on.
So what we have that we're going to look at real briefly is the show notes. We have these on our website. They're also in the link below the video. We're not going to spend a lot of time here. A lot of the information is on the board, but if you want some more detailed information, this is where you can get them. And so we have the first page is just the different brackets. It's where we pull a lot of the information. I have this sheet right on my desk. I use this daily, really, to look at different planning stuff. So this is something you can get. And then the next one is really just is from directly from the IRS website that talks about planning strategies, what you can do with the gift estate tax, how that's reverting back to in 2026. One of the big things that they list in here is that if you do a gift now, they're not going to claw that back in when they reduce the estate tax. They cut it back in half in 2026. So if you have a really large estate, what we have some people doing is giving up to using up this $12 million, almost $13 million exclusion now, and then they get to preserve that into the future. So just if you have a very large estate, let us know. We can talk to you through some planning strategies there. But again, these are on our website. They're at the link below. And so if you want more information, go look there.
I'm Hans Scheil.
And I'm Tom Griffith.
And we thank you for listening.
Thank you.